Good morning. You're watching the market right here on ET now. It's a brand new week and lots really to digest from when we closed it off on Friday up until now. Yes, the week gone by, we almost had a touch and go moment with that 20K mark. We were only 20 points shy from that level in Thursday's session. But Friday did peg us back. Firstly, the Infosys numbers, and then in anticipation of what Reliance is going to deliver on Friday evening, which it did fall short of expectations, that stock as well cracked down pretty hard. Having said that, FIIs continue to pour in money, and as of year to date, it's already a quantum of about $1.2 billion. But yes, Infi, Reliance, that really pegged us back and dragged us quite a fair bit. This morning, there's nothing really much to talk about in terms of global cues. It's pretty sedate and quiet, but I guess our markets have lots to digest. And 20,000 seems a little further away.
Yeah, you've just gone there and you just retraced, and then the flow and the sequence of the event is such that right now the trigger is missing. And I think that is my sense as well. The surprise from the earnings season is missing. On the upside, is certainly not there. On the downside, few companies have disappointed. So the earnings season so far is off to an okay start. And when markets are sitting at 20,000, you don't need an okay start. You need a great start. And since that earnings upgrade cycle has not started, you could ask yourself is that what is the trigger? 50% of the earnings season so far is over, and barring one or two upgrades here or there is nothing in the system which can really generate a lot of upside momentum. The other question is that we got hit because of Infosys. The Reliance, large part of the price discovery that is behind us, numbers were just about in line. So now the only wheel which in a sense will have to do all the heavy lifting would be banks. So it's Reliance and Infosys on one side, banks on the other side. Can banks really do all heavy lifting? And I think if the fundamental push in the market is missing and if earning upgrade is missing, the market, there are two pillars if you're batting for the bulls. One are banks and second are flows. So can flows continue to drive the market higher, and can banks really keep on taking the entire market momentum higher in terms of a sector? I think that's the easy setup to understand.
Yeah, absolutely.
Yeah, and Nikunj, since you're talking about earnings, that clearly seems to be the big talking point. And you had clearly 21.5% of the overall Nifty weightage that came out with their numbers from Friday till the end of the weekend. RIL, Kotak Bank, HDFC Bank, ICICI Bank, and IndusInd Bank. And if we were to just sum it all up, like you said, it's nothing that inspires any confidence. RIL, the O2C business as well, didn't quite deliver. It was a bit disappointing when it came to HDFC Bank. So the heavyweights haven't really passed the muster.
Let's spend a minute trying to understand Reliance. Now, for a Reliance shareholder who's a genuine long-term shareholder, they should be saying thank you, Mr. Ambani, because that 260 rupees of price discovery is something which was unexpected.
The bonus, like you said.
It's like a bonus. It's like a free share you've got, and that's almost 8-9% of the current market underlying stock price. So that comes in. Now you got to ask the core business. Now that the price discovery happened, the combined value of Reliance after the price discovery, the stock went to an all-time high. For the better part of this year, the stock has been a sleepy stock. Now that price adjustment is over. Those free shares will hit your demat account and they will start trading somewhere in August. But independently, if you look at the core business of Reliance, GRM, Geo, retail, chemical, stroke refining, there was nothing large which will warrant an upgrade. You may argue back and say that the trend in second half will be better than the first half because GRMs are improving, but none of the brokerages have come out with something which could be called as a big loud upgrade or a price target change. Now for a stock where such a large event in terms of price discovery is already over, it may really not be the motor stock, it may not be the engine stock. So last week, if you frankly ask me, Reliance was the engine stock which really took the markets higher. That zinc post numbers would be missing. So Reliance at best may stagnate, and that push for Nifty to go higher, which was coming from Reliance, will not be there. That's my limited point.
Yeah, the question is who's going to do the trick for the Nifty then, if at all we make an attempt back to that 20,000 mark. A lot of bank numbers as well to digest. Look at the commentary coming in from HDFC Bank, for instance. They're saying that they're looking at competitively priced deposits, lower credit costs, which they think is going to offset higher OPEX. Kotak Bank is saying that the leadership transition is on track and no stress in their unsecured book. ICICI Bank, they're saying that NIMs will moderate at a cost of deposits rise. The cost of funds will continue to rise, however. And IndusInd Bank says that the cost of deposits is going to peak in the second quarter. The FY24 guidance is credit cost guidance, that is about 1.1, 1.3 odd percent or so. And I think that's the question, right, Nikunj? It can't be Reliance. It won't be Reliance today for sure. Can banks really do the trick?
Aisha, just look at the four numbers which you spoke about. And we are looking at an average 20% growth, 15% plus growth. 15% plus growth on that kind of a balance sheet size, I think is super duper. NIMs are strong, PAT is strong. Even though banks are in heavyweight sector, I think they will be in the driving seat. And I think they would continue to get lion amount of market share and lion amount of flows also. So nothing wrong with the banking numbers. The banking sector per se, I think the trend is clearly visible, which is that if you look at the large versus small banking comparison, large banks is where the large amount of market share, large amount of profitability, large amount of balance sheet scale up, I think is clearly visible. So large versus first banking, good set of numbers. Will they warrant a major upgrade? No. Will they just cement the optimism? Yes. Within banks, it is mid cap versus large cap. Large caps are the ones where the puck clearly seems to be moving. And within the large cap, now this is the important one. If I look at the first four set of numbers which have come out, HDFC Bank, Kotak Mahindra Bank, ICICI Bank and IndusInd Bank, in my book, the standout number I think is ICICI Bank. Of the comparison, if you do.
Yeah, the only thing is that did the market not price that in? I mean, ICICI Bank is already sitting at highs. So is the good already baked into the price or not? And how much will the market reward ICICI Bank stock after looking at these numbers?
So Aisha, the consensus view, and there's a difference in consensus view and consensus pricing. I'll try and explain it. Consensus view is that banks will do well. Consensus pricing is that when markets are factoring in all kind of growth rate and these price to books are reaching levels which we've not seen before with this kind of a growth rate. So I don't think these banks have reached what could be called as really Humpty Dumpty level in terms of valuations. B, the growth is so strong that in a sense will continue to give them this kind of a commanding premium. See, the subsidiaries are filing full cylinders. The argument in the banking space now is that will they be market performer or will they be market outperformer? I think they will be market outperformer. And within banking, you got an area of bank. You start from SBI and you go all the way down to Yes Bank. And you can see that how Yes Bank numbers were not great, but HDFC Bank numbers were great. RBL, AU is struggling, but ICICI Bank is no problem. So the puck, I think, is now clearly with large cap banks. And mid-cap banks are not really, even though their balance sheets are small, they are struggling.
Yeah. And Kotak has spoke what the market wanted to hear, that the leadership transition is pretty much on track. In fact, let's hear out snippets from the conference calls of ICICI Bank as well as Kotak Bank after their numbers came out.
See, what's happening really is ultimately the margins have moved up. If you see over the last, 3-4 quarters as interest rates have moved up, because today the way the pricing works, the pass on to the customers is immediate, and hence it reflects on the margin immediately. The cost of funds takes time to build up and catch up really. Yeah. So as the cost of fund keeps moving up, the margins will tend to keep getting slowly sliced, and they will come back to the normal 5.25 types over a period of time really.
20% of the trade transactions were done digitally in Q1 2024. The value of transactions done through Trade Online and Trade Emerge platforms in Q1 2024 has shown year-on-year growth of 1.4 times the value in Q1 2023. Moving to asset quality, the net NPA ratio was 0.48% at June 30, 2023, compared to 0.48% at March 31, 2023, and 0.7% in June 30, 2022. During the quarter, there were net additions to gross NPAs of 1,807 crore rupees. The gross NPA additions were...
All right, the spotlight was clearly on the big earnings for the week gone by, but it's going to be a very hectic week on the earnings calendar because a lot of companies will be reporting their quarterly numbers this week as well. A lot of heavyweights, so we're expecting earnings this week from the likes of Tata Steel, Bajaj Auto, Asian Paints, heavyweight L&T, SBI Life, as well as Bajaj Finance, Dr. Reddy's, really the list goes on. So Nikunj, it is as well going to be very important to track a lot of these numbers.
See, it was IT 2 weeks ago, it was banks last week, and it will be autos this week.
Yeah.
Now, auto is, I think, is the sector of the year. Now, here companies not only have to meet expectations, but they have to say something very. The stocks are 50 to 60%. When stocks are 50 to 60%, when the basic dynamism of the sector is gradual improvement, not a marked improvement, and stocks have gone absolutely. They've just been on a pent-up demand trend, so to speak. The numbers really have to be super strong. Little bit of slip here and there, and that could be a recipe for disaster. So, frankly, if you ask me, with IT, markets were not expecting anything large, and stocks were subdued. But with autos, markets are expecting a lot, and stock prices, in a sense, are pricing in a near perfect scenario. So, Tata Motors, I think, would be the tricky one, and then followed by TVS, because they both are performing stocks. I think Leyland numbers are decent. You can't argue that anything wrong with that. If Leyland numbers are anything to go on by, you would say the trend could be okay. But I think in terms of a mood point, I think the mood point this week would be centered in and around autos. And then good old Bajaj Finance. What they've indicated in terms of the quarterly update, they are growing on a different, plane, so to speak. So markets know that what kind of growth numbers are coming. So I think Bajaj Finance numbers, unless the fine print is a disaster, I think it would be a number which will come and go, and the stock reaction may just not be there, because the stock already reacted after the quarterly updates.
Yeah, absolutely. Okay, let's bring on board our chartists and figure out whether this week we're going to have a tryst with 20K again or not. Kunal, Naresh, hi morning. Kunal, lots on our plate this morning. While last week it was Infi and Reliance, which kind of pegged us back till the run up to Friday. This morning, a lot of earnings to digest. Reliance has been a miss. ICICI Bank inline, Kotak a beat. What are the charts looking like for the index? Firstly.
Good morning. So again, my belief is that the indices are now getting stuck into a range which was earlier at 18,800, 19,000, and then there was a phase of 19,500 acting as a resistance. So these round figure marks are acting as a major psychological as well as blocks for the indices to cross over, because we've ideally taken a lot of time, 8 to 9 days of consolidation, which happened I think at 19,500 mark. Now there are two important data points which was spotted on the index on Friday's trading session post. When the data came out. One was one of the sharpest reduction of open interest on the Nifty futures. So almost 8 lakh of unwinding was seen on the Nifty futures, which is one of the highest in the July expiry itself. And that tries to gel with the 190 points drop on the Nifty futures. And the second, the most important data point was on Thursday, we'd hit a put call ratio of almost 2.1. The last time we had hit put call ratio of 2.1 was on Bank Nifty. And from there, the Bank Nifty corrected by I think 2.5 to 3%. So if we can try and replicate the same, then we can probably be expecting the Nifty also to trade in a range of 2% to 3% lower than the 20,000 band. So which means closer to 19,500, we should find some very good support for the index. But on the upper end, I think 20,000 to break that 20,000 mark, at least for the next couple of trading sessions, could be a lot more difficult.
Okay, let's find out what Naresh's take is on the markets. And Naresh, after being just 20 points shy of the 20K mark, now we're scaling back to nearly 250 points away from that level. Given all that's transpired over the weekend and the handover, what are you working with by way of levels?
So what we are seeing is overall, if you look at the Nifty Bank, it has made a new all-time high. High tops and high bottoms continue. It has not broken the previous day low, which is what happened almost in the Nifty 50. We broke the previous day's low. So that's where the structure is a little better. And out here, the main constituents are looking interesting. So ICICI Bank hit a new all-time high. SBI has come close to an all-time high. HDFC Bank continues to sulk, but we are seeing some bit of a recovery in Kotak Mahindra Bank. So overall, for the near term, 45,500 should act as a base, and upside could continue after even testing that 45,500 level. So it's a hold on the Bank Nifty. In terms of Nifty, what we are seeing is, say, IT has topped out. Now we are looking at Reliance Industries also making a pause. Overall, getting into a consolidation on the Nifty, 19,500, 600, which was the previous top, should act as a support. 20,000 should act as a resistance. And interestingly, the mid-cap, small-cap indices also continue to hit a new high. So the momentum is pretty strong across the board.
Get stocks as well. Kunal, what's on your radar this Monday morning?
Coromandel is the first stock which I would suggest as a buy. Fresh breakout in the stock, crossing that level of 980 for itself on Friday. So would suggest a buy with a target of 1060. Stop loss could be kept at 960 for Coromandel. And ONGC is the other stock which has confirmed a breakout of 170 mark. So fresh breakout for many of the PSU names. ONGC is one of them. Would suggest a buy with a target of 178. Stop loss at 166.
Right. Naresh, what about your stock-specific calls?
So looking at the same names in the oil and gas space. So first is a buy on ONGC itself. The stock has given a breakout into a new 52-week high, as well as if you were to look at it on a dividend-adjusted basis, it is finally getting to a 5 to 8-year high. So technically, the setup looks very promising. The stock is, say, around the windfall tax, the stock used to be 155, 160. That used to be a resistance, and now it has started acting as a support. So multiple resistances at 170 cross. This could be start of a rally, a bigger trend in the making. So an initial target price of 190, stop loss at 166. The second is a buy on GAIL India, which has tested that 112 to 114 mark almost eight times over the last 2 years. It had topped out around these prices back in mid of 2021, then in end of 2021, in the start of 2022. And over the last 6 months also has made multiple attempts. So a classical cup and handle formation, a big range breakout in the making. Sustaining about 112 to 114 could be a big move. So preempting that move, keeping a stop loss at 107 and an initial target price of 125.
Okay, let's talk individual stocks, and Anisha is in the studio to discuss what you need to keep on your radar this morning. And Anisha, DLF, quite a surprising set there. While the sales are steady, collections are steady, but the operational numbers are not.
Oh, well, yes, it's largely in line to a slightly muted number when it comes to the P&L, but the internals look strong. So not much to complain when you look at the internals, because yes, as you pointed out, the operational performance was a bit mixed. But if you look at the pre-sales number, that continues to be flattish on a quarter-on-quarter basis. And remember, Q4 was very strong for the company. So maintaining that momentum despite not having a big launch in the quarter gone by, that's a thumbs up coming in. So pre-sales of 2,000 crore was quite nice. The collections have also improved on a year-on-year basis. So almost 50% improvement in collection, and that means your free cash flow generation has been strong, and that means that you were able to strengthen your balance sheet further, and they managed to reduce the balance sheet by around 665 crore this quarter as well. And this is one of the best numbers that we have seen in terms of the balance sheet in a long time. So despite having a slew of launches lined up of almost 20,000 crore worth in terms of gross development value for the rest of the year, the company's balance sheet looks very strong. But Nikunj, I'm more intrigued to ask you about what do you think of this re-foray that they are making into the Mumbai market. Prestige wanted to come back to Mumbai. Now DLF has tried its hand earlier, burnt their hands earlier, but now they're doing it in a JV and trying to redevelop one of the slums in the suburban.
See, I think it's not going to move the needle for DLF. I mean, for DLF, anything in terms of in JV trying to redevelop, they're testing waters, is what I understand. Because, you'll be surprised that the place where we are, the DLF plot development was just next to our office. Yeah. And then it was sold to Lodha. And this, in a sense, was a clear indication that DLF came to Bombay and they were not really able to understand how things actually move there. Frankly, DLF always has been this NCR-focused company because they understand the market. They have access to good critical land bank, and they've got a defining brand which in a sense really makes them stand out. The way I look at DLF is that you cannot look at quarterly numbers to really judge how a company would move. And just to break it for our viewers, that if you launch a project in that quarter, the numbers will look very different. If you don't have a launch, the numbers will look very different. So with DLF, you cannot do a QS, QT or quarter wala comparison. What is important with the company like DLF is which way FCF is, free cash flow is moving, and what is happening to, in case of DLF, the launch pipeline and the rental pipeline. The launch pipeline is robust. Office pipeline in terms of rental seems to be improving. There's another technical factor which we don't realize about DLF is that 75% is owned by promoters. Right, 75% is owned by promoters, and about 18-19% is owned by foreign institutional investors.
So the liquidity is very
less. So that in a sense would be the technical factor which clearly could be at play for DLF. I mean, given what's happening to the Chinese real estate markets, and I'm forgetting the name, Evergrande. Look at the fat loss they've reported, which is one good, large, clean real estate play available for a global investor, equity investor. See, the P guys have come into DLF, but they've come into DLF they've come into the private equity guys have come into the real estate market, but they've taken project financing.
Project level. Yeah.
Nobody has done an equity investing. So for an equity investor who wants to take a large play in India when the real estate market is growing, what are the options?
Avenues, yeah,
So
very less.
that I think would be a differentiating
But
factor.
one needs to factor in the fact that real estate sector has been one of the best performing sectors this year. DLF itself is up 30%. Let's see whether that cycle continues or not. But the other space which has been heating up quite a bit, of course, has been banking names, and especially the mid-tier banks. So let's talk about a slew of earnings that came over the weekend there as well. RBL Bank, Yes Bank, AU Small Finance Bank, just to name a few. Let us start with AU Small Finance Bank because that's been the talk of the town. That was considered to be one of the very marquee names in terms of the mid-tier banking, and that was the reason that it was commanding a higher valuation. It was almost trading at 3 to 4 times FY25 price to adjusted book. But now the earnings are softening a bit, or let me say moderating a bit, and that's why we have seen a couple of downgrades as well. Today, of course, Axis Capital also downgraded. They said that the profit was a bit ahead of the estimates, and the NII was just up around 3% on a quarter-on-quarter basis. The NIMs had sharply declined because it was down almost 40 basis points on a quarter-on-quarter basis, and even in terms of deposit, it wasn't as much as the street was expecting. So the deposit growth was muted sequentially, in fact, flat quarter-on-quarter. Nikunj, do you think whatever was the re-rating trigger for AU Small Finance Bank has played out and now it will be a bit of a consolidation, or do you think the marquee name will continue to command a premium valuation?
See, the stock got re-rated when Sanjay got an extension.
Correct.
And markets know that, look, the man understands growth, aggression and risk management. Now, when you are growing a bank, well, you understand risk, you understand NPAs, your margins are one of the best in the industry, your book has no problem whatsoever. You also need deposits, which is that your CASA has to be strong. And I think the fault line for AU for the quarter gone by is the CASA has not grown and the cost of deposit has been in challenge, which the management is claiming that it has peaked out now and the war for liability is over. So if the cost of liability for AU is over, and if the deposit war is getting over, then AU can actually come back in the second half of this year. I don't think growth is a problem. I think it's really CASA and the cost of deposit, which in a sense they need to manage in this competitive environment.
Yeah, CASA coming down to 35% was a bit of a challenge. But the other one which hasn't been commanding good valuation is RBL Bank. That has faced its own issue. This time around, the earnings wasn't really bad. Let me quickly run you through the numbers. The NII growth of 21% year-on-year was largely in line with expectations. It's the lower operating cost that has managed to aid the profitability because that jumped up by 43% on a year-on-year basis. The slippages have also moderated to 3.2%, and that compares to 3.9% that the company reported last quarter. And in terms of the overall cost assumptions as well, the management was sounding very confident that NIMs will improve from here on, and that there is a estimate of 5 to 5.1% as far as the NIMs are concerned going forward. Of course, the stock trades at cheaper valuation than rest of the peers, sub 1 time the FY25 earnings for this one, Nikunj.
No, see, the puck I think is moving towards large cap banks to simplify it very easily, because see, please understand that when there is a war of liabilities, just to break it for our viewers, there is a war for liabilities. Everybody wants to take that extra deposit. Big banks will always gain, and that I think is the story. Look at Yes Bank. I mean, with all the hope and hype with the PE investor coming in, where are they? AU we discussed, RBL is just about there. So I think the re-rating in small and mid-tier banks is over according to me. And I think the right to win, I mean, it's a very strong word to use, I think is the one who gets the CASA. And in this case, large banks are getting that CASA. It's very simple.
You used the word war. Did you catch Oppenheimer finally, Nikunj?
No, I actually tried. And I was absolutely amazed that not that the number of shows were less, the number of shows, at least in PVR and Inox combined.
24 hours running. There's a 3 a.m. show as well.
Yes, and the ticket pricing.
There's a 3 a.m. show and people are thronging.
10:30 in the morning show, it was all packed.
Wow.
Yeah, so
I must have got just the last 2 tickets available.
I tried, wanted to go with my son, but no 2 tickets together were available. If they were available, one in the last seat, one in the front seat,
I
not
get
happening.
you, I hear you. Yeah.
And
I managed to catch it. Did you?
Of
You
course.
did.
She said
And what
10:30.
about you? Okay. So, but Barbie, did you manage?
No, I'm a Barbie guy. Does it look like I'm going to go to Barbie?
We don't stereotype here. We don't stereotype here. Anybody
Barbie
can
not
go for
happening for
any
me.
movie. There is
Barbie
no
not
line
happening for me.
marking anything.
No, Barbie not happening. Whether
Oh my
whatever you
God,
may.
but that's a very strong no. I didn't think of you to
Barbie
be so
not happening.
stereotypical.
No, it is not stereotypical, just not my types. Let me put it this way.
Exactly. Fair enough.
Okay, that's that. But yeah, I think unless there is a bigger movie than these two in the year to come, I think Oppenheimer is going to be winning all the Oscars.
Absolutely. It was quite a performance from Nolan, of course, behind the scenes, and then Murphy on screen. And even Robert
Downey
John,
Jr.
I think he
Oh
took
my
the
God.
cake completely. What a
Completely.
stellar performance.
Anyway, can go on discussing movies, which we will, I'm sure, in the due course of the day. But Prabal Sen is here, not to discuss whether he caught Oppenheimer or Barbie, but yeah, to discuss Reliance. And Prabal, while retail and Geo seem to be firing all cylinders, it's the oil and gas business which was a bit of disappointment, I guess. What was your read-through of the numbers?
Yeah, I think the OTC segment obviously has been a little bit muted. I think the advantage of Russian crude and the lack of windfall taxes notwithstanding, what it does look like is that GRMs did probably drop by maybe $3 to $4. Let me clarify that Reliance does not disclose its GRM numbers. These are our estimates based on the product slate that we have, and our estimates of product spreads. That GRMs overall should have actually dropped by about $3 to $4 sequentially for Reliance. And even in the petrochemical segment, what they did mention is that the margins were little bit of a mixed bag, with some QOQ improvement seen in PE and PP spreads, but for PVC the spreads were particularly weak. I think the important thing really is that if you look forward to the next couple of quarters, the extent of Chinese demand recovery continues to be a key monitorable. I think the management did mention that they are seeing decent demand strength, particularly in the domestic market for petrochemicals. But for the refining market, it's overall Chinese demand, which will be a key monitorable. Till that actually comes through, one suspects that even for Q2, the OTC segment earnings might remain a little bit muted. You did mention Geo and retail, at least on a YOY level, continue to grow strongly. That momentum will be there. And then the one bright spot that I would look at it is that on the upstream front, gas production continues to actually meet the guidance. They have signed up sales contracts for at least 28 to 29 MMSCMD. So that segment continues to actually deliver the kind of revival that had been promised a couple of years ago. And the fact that net debt also has been flattish on a quarter-on-quarter level, that's another thing that is a little bit of a positive. But from a earnings perspective, I think we are set probably for another couple of quarters of weakness before you can see a meaningful recovery happening in operating earnings.
Also, Prabal, do you think that for the energy business, the worst could be behind? Because there has been a sharp pullback in the GRM. So, one would deduce that in the quarters to come, this would mark an improvement.
Honestly, if you look at the Q2 levels, while GRMs have pulled up, the petrochemical business remains, a little bit muted. I think there is still a long way to go for petrochemical margins, particularly on a YY level. If you really look at it, key petrochemical deltas are still way, way below what they were in FY23 and well below 5-year average levels. So you're right that there has been some recovery in GRMs in light of the fact that the new production levels of OPEC plus countries, specifically Saudi Arabia, started to kick in from the beginning of July. And that has prompted a little bit of recovery in both crude prices as well as product spreads. But that won't on its own be enough for the OTC segment to really start, firing. If you look at the annualized run rate of EBITDA that I think our estimates and maybe the street estimates also suggest, that would be anywhere from 65 to 70,000 crores. Whereas on the basis of the run rate for Q1, they are looking at somewhere around 60,000 crores. So that's what I mentioned, that H2 actually needs to really come through for RIL to sort of meet street estimates on earnings, both for OTC as well as overall consolidated numbers that I think we are all building in at this point of time.
So what's the call on the stock looking at the numbers, Prabal, now that, the adjustment of Geo Financial Services is out of the way?
Well, frankly, the adjustment does, basically does nothing for RIL per se, other than basically adjusting the share count upwards. Because now, when we were used to look at diluted earnings, we used to exclude the 410 odd million treasury shares, which now gets added back because now there's a external shareholder of those shares. Other than that, we've not really changed our earnings much. We've had an ad rating on RIL with a 5 to 6% upside for some time now. That remains. Our basic contention is very simple. We do see peer leading earnings growth continuing to be there for the company for the next couple of years. We think that RIL will probably lead the large caps in terms of pace of earnings growth at about 18 to 20%. And the earnings potential of new segments is also not in doubt. The only thing that sort of curbs our enthusiasm a bit is that capex continues to run ahead of what we had thought, and therefore the FCF yield for the company, that's free cash flow yield, probably will remain in the sub 2-3% levels. And because of that, the return ratios for the companies will probably remain at sub 10% levels. So combine that with the fact that the stock is already trading at somewhere around 18 times on a 1 year forward level of 140 rupees a share, which is what we are building in. And we think that the upside gets capped at between 5 to 7% from here on in, which is why we have sort of a cautious ad rating on the stock as of now.
Sure. Prabal, great to have you on the show this morning. Thank you so much for taking the time out.
Thanks for having me. Thank you.
Okay, that's the analysis on Reliance. Look out for what this stock actually does in trade. Could be some more of a negative move even after Friday's price action, as would be the case on NAU Small Finance Bank as well. Kotak ICICI Bank have managed to deliver. Credit Access, CLSA has raised the target price to 1600 versus 1350 earlier. And then HCC, the Lavasa resolution plan has been okayed. So let's see whether you see some positive moves coming in on this stock. The Gift Nifty, though, is indicating a very quiet start for us. On that note, we're going to take a very quick break. When we come back, we'll have our fundamental expert as well join in on the show.
Welcome back to the market. Let's focus in on some ET Now exclusives then. And we learned from reliable sources that Bain Capital has signed the deal with Adani to buy Adani Capital. Let's get in Anurag Joshi, who joins us with all the details as the news has been confirmed. Anurag?
US private equity firm has bought Adani Capital. Now, the key takeaway here is that this is seen as billionaire Gautam Adani's push to exit certain non-core businesses. Adani Capital was one of the first assets of Gautam Adani, which was on the block, and now this has been sold to Bain Capital. ET Now had broken the news on Saturday about Bain Capital clinching the deal and buying Adani Capital. And the transaction, which the details which have not come out yet in the official statement, is that they are buying this company for an equity value of 1,600 crore rupees. That's twice the net worth of the company. So that's a very attractive valuation at which this transaction has happened. Another key takeaway is that they're buying 90% of the equity of Adani Capital from the Adani family, whereas 10% which is held by the MD and CEO Gaurav Gupta will continue because Mr. Gupta is rolling over his investment and he will continue as a CEO of the new entity under the ownership of Bain Capital.
Right, Anurag, we leave it at that, and that's what you heard first on ET Now. Let's welcome on board then Shenu Agarwal, MD and CEO at Ashok Leyland, and talk about their numbers. Mr. Agarwal, great to have you on the show. Firstly, in the first quarter, your gross margins have improved about to 26%. EBITDA margins are the highest in last 4 years. Are these margin levels sustainable, and can we expect a similar margin level for the full financial year as well?
Definitely, that is the intention that, we want to keep it at double-digit levels. Of course, a lot of factors do play on this. But I think because the market is looking good and it will continue to grow as we think it will in quarter 2, quarter 3 and rest of the year. And our cost reduction effort will continue. Also, we think that there is a certain amount of easing that might happen in the commodity prices. So I think if all that happens, we do hope to sustain our margins at double-digit levels.
Okay, Mr. Agarwal, how much did defense and spare parts sales contribute to your top line in Q1?
Yes. So both in defense and spare parts, and actually all our non-CV businesses, we have done very, very well in Q1. Our defense sales, last year was quite subdued. So we had a much better year or much better quarter this year on defense. Our parts sales last year grew by 30%. And on top of that, in this quarter, we have again registered a growth of more than 30% in our part sales. And these are both good margin businesses. Other than this, even the power solutions business has done very, very well in Q1. So I think everything is working out quite well, and we hope that it will continue to be like that in rest of the year as well.
Right. So is it fair to say that the Q1 margin improvement was only because of higher spare part sales?
Oh, no. Spare part sales is a very, small percentage of our overall top line, right? So that is not the reason. As I said, we had growth in volume overall, whether it is MHCV, whether it is LCV, whether it is power solutions, parts or defense or other businesses. And also we had a lot of focus on cost reduction overall, right? So because of these two things, we could register a double-digit EBITDA in Q1.
So for the Switch, the EV business, when can we expect a stake sale? When can we see a fundraise? What are the updates on this front?
I think we have been very transparent about that, although we have been trying to raise funds in Switch, but it hasn't happened because of the market environment. So Ashok Leyland has decided to support it directly because Switch business is very, very strategic for us. It is Ashok Leyland's future in many ways, right? So we have already committed a sum of amount that we will invest in Switch, while we will continue to get the right partner into Switch at the right valuation as well. But until that happens, Ashok Leyland would directly invest in Switch to grow that business.
Right. On a year-to-date basis as well, if we see FIIs are pouring in funds into the Indian market, the auto index is one of the top gainers, car sales have been on the rise. The way we see it is everything is looking positive. Then why, did the fundraise stall for you? Is valuation one of the concerns?
No, I think the main reason is that, in last few years, a lot of funds have been poured into electric automotive companies. And especially in Europe and other parts of the world, some of these companies had not been able to kind of meet their business plans, right? And therefore, there is some amount of hesitation as of now. Also, the kind of market development that was supposed to happen outside India in some of the developed economies, just because of the overall situation, economy situation and the geopolitical situation, I think that is not happening at the same pace right now. So I think it is just a kind of a delay that we are seeing in the overall sentiment. But electric and other alternative fuels is very inevitable to happen. So I think we are just waiting for the right moment when the interest comes back into investing into such companies. And as I said, until that, Ashok Leyland would continue to invest in Switch. And fortunately, we are in a position that we can invest in this company.
Okay, thanks very much for giving us that clarification. Company has decided to directly invest in Switch, as they've been saying, and they hope that sales momentum will continue. Let's bring on board Sandeep Sabharwal, who joins in to discuss fundamentals. Hi, Sandeep. Good morning. So much to discuss. Why don't we start off with your thoughts on the banking space after a lot of those heavyweights came out with their earnings? Any key takeaways?
I think one of the biggest takeaway from all the banking sector results, certain majority of banks have reported, and the key takeaways are: one, the net NPAs seem to be under control. There don't seem to be fresh incremental additions into NPAs at this stage. Now, there are some fears that unsecured lending could lead to some uptick going forward, but that's something we need to see. Bank balance sheets are very healthy, and deposit growth has started to move up as banks have started increase rates. There's some moderation in the interest margins, which was expected. Overall, a healthy performance like this quarter. I think all banks and NBFCs combined will have a profit of 1,50,000 crores, which is a huge change over what was there 5 years back when there was, I think the banking industry was in losses. I think this is the biggest positive for the Indian economy, the healthy banking sector and that will continue to support growth of the economy.
A lot of other numbers as well, which are going to be on our radar. And Paytm as well came out with its numbers. Remember, there's been an improvement in the payment net take rate as well, which has been a surprise. There's been a lift in the EBITDA as well that one has seen. And most brokerages are actually reacting quite positively to the numbers. I was just going through CLSA's note on Paytm. They're maintaining their buy. They've hiked the target price as well to now 1,050 from the earlier 850. They're saying that they're scaling up in lending, but ticket sizes are rising. They've actually moved up the EBITDA estimates to about almost 9 to 12 odd % or so. Sandeep, I don't know if you've had a chance to look at Paytm and if it's a company that you're willing to give a shot.
Not really, Aisha, because simply because of the fact that I don't think they have any sort of sustainable business model. One, their core business is sort of stagnating. It's growing, but it's not growing at the same pace. The entire improvement in profitability is coming out of the commissions they earn out of loan origination, which is a business which is actually a no PE business. You can't give PE to commission earning companies. So because that's a business which you just originate a loan and get your 2% or 1.5%, and that if someone does a deep analysis, that's the only thing which is leading to whatever improvement is happening. And the stocks also doubled from the bottom. So incrementally, I don't see any reason for bullishness.
All right, let's discuss the stocks that are on the editor's radar today. And today we're going to focus solely on Vedanta. Let's, get in and do a deep dive, Nikunj, on the kind of quarterly numbers, because I think that it's been weak across the board in terms of the commodity prices, the capital allocation concerns, and net debt increasing.
So, Avan, look, commodities, they go through a cycle. So not that anybody was expecting anything big from the commodity business per se, but there are a lot of other question marks or concerns or wrinkles which are very basic, which you could ask yourself that what is going on in Vedanta? First, the debt levels. Yeah. Then B, their foray into essentially semiconductor when the debt levels are high. And see, it always puzzles me that you got 68% ownership of Vedanta is with promoter. Almost 99% is pledged. Now, they've been using a lot of dividend from the balance sheet of Hindustan Zinc and from Vedanta, and that dividend in a sense was being used by promoters. In this case, 68% ownership is there to service the debt. But guess what? That cash flows are reducing, given that the royalty changes have happened, given that, commodity prices are not in a bumper parabolic move like they were in 2021 and 2022. So I know there is a lot of temptation to buy into Vedanta because the dividend ratio on historical basis, they look strong. But my limited point is that metal is not the best space to go. And within metal also, if there is interplay because of China and dollar index, Vedanta always tends to do well. My sense is that one is better off giving the stock a miss, because I'm not so happy about the capital allocation policy. I've gone on record and I've said that. And whatever the promoter is trying to do, I guess it's not convincing enough for someone to say that, okay, I can tell you the roadmap and where the vision of the company is, because there's just too many moving parts in the balance sheet now.
Yeah, and all that are flagging off, little alarm bells. So that's Vedanta really, Aisha, the editor's take on the stock.
Yeah, that's the take coming in on Vedanta. But Sandeep, let's talk about DLF. The net debt has now declined to about 57 odd crore rupees. They're looking at re-entering the Mumbai market as well. Clearly the most rewarding of the lot. What are you making of the numbers?
So DLF results were, I think, mixed. One, like you rightly said, on the net debt front, I think they have been very serious on reducing debt in the balance sheet and moving to a zero debt status. So they are virtually zero debt now, which is a very big positive, and that's something which has driven the valuation. However, there was a slowdown in overall sales as well as margins, etc. And I think that could be an overhang. So in a nutshell, I would think that given the strong upswing that the stock has already seen, from here on moving higher in the near term will be tough. So I think the stock will go through a phase of consolidation. Company has talked positively about future deal momentums, etc., sales. So I think that's something we'll need to watch out for over the next few quarters.
Okay, Sandeep, now let's talk about the sector of the year so far, and that's autos. There is incremental improvement in the underlying demand for autos, but there is a substantial improvement in the way how markets are now betting on auto stocks. Do you think somewhere reality will catch up that auto is a great sector to be in, but the changes are incremental and they are not so strong that the auto stocks will warrant a 40-50% rise?
See, I think Nikunj, it warrants a rise because of the fact you see what Ashok Leyland delivered. I think the margins just went out of the roof. And if that's something which some of the other companies can also deliver in terms of incremental margin improvements, then I think this can sustain. Secondly, I think early part of the year, given the monsoon, etc. forecasts, a lot of people sold out auto stocks, saying that the economy will suffer and as such, volumes will suffer and volumes will not improve. And that thesis right now seems to be off, given whatever is happening around the country. And thirdly, the input cost pressures. So input costs increased, steel, etc. prices rallied initial part of the year, but they have given up all their gains. So I think from the wrong input price cost pressure point of view, also these companies benefit. And lastly, and most important, which I track very closely, among institutional investors, auto stocks are still very, very underowned. You hardly see any stock, any auto stock in the top 10 of any large fund. And that, I believe, becomes a contrarian indicator for the sector to perform.
Have you added off late in last 1 month while you were away on a holiday? What did you buy there? What did you sell there?
I think we added PVR because it got sold out so much. So I think that's something which we added incrementally. Beyond that, nothing which comes to mind. I think incrementally, just keeping on adding the stocks which we own. So because that's where the companies are doing well.
On to your key positions in, let's say, Mahindra and Mahindra, even for that matter, Tata Motors and Titagarh. These are three stocks which we've discussed.
Yeah, because I'm holding on to Titagarh. I think it's just performed crazily. I don't like some of those stocks. You don't understand why they go up so much, but then we are happy that they are going up so much. I'm not buying at this price, but I'm not selling also. M&M, Tata Motors continue to do well. I think among banks, ICICI Axis Bank is what we hold, and among NBFCs, we hold M&M Financial and L&T Finance Holdings, a small quantity, not very big. So I think all these stocks are doing decently well. Results also indicate, I think the result season is very interesting because I'm seeing very positive surprises from small mid caps as a general category, and on the large cap side, we are seeing mixed results. So I think that will give opportunities as the results come out for this quarter.
Okay, we'll discuss some of those heavyweights when it comes to numbers as well with you in depth, Sandeep. But in the meantime, time for our smart portfolios. With markets close to those life highs, a lot of ace investors are rejigging their portfolios. So it'll be interesting to find out what exactly they're buying, what they're selling. We've got Sharad here. He's done that data analysis and now joins in with the smart portfolio. Sharad, which portfolios are you walking us through today?
Well, today we are having Ashish Kacholia's portfolio as well as Mukul Agarwal's. First, we'll point out Ashish Kacholia's portfolio, and of course, most of the action coming in the small cap space. Over here, we see Ashok Industries. There has been almost a 18 basis points hike, but he has actually reduced his stake when it comes to Chalet Engineering. Two new names coming up, new entries, Venus Pipes and SG Finserv. Earlier it was called Mungiba Securities. So that is where we are getting a new entry. Apart from this, also we are having stocks such as Knowledge Marine and D-Link, which are actually in focus. It was kind of a buying happening, but do remember that the two exit is happening, and these are the two names coming from the United Drill as well as D-Link. So this is coming in, the first one is coming in for Ashish Kacholia. Apart from this, next move would be investor Mukul Agarwal and what smart bets are happening. And yesterday itself, an interesting development happened. Suzlon Energy reported its shareholding pattern and stock has been buzzing, and we see a new entry coming in. Earlier, his name was not there in the shareholding pattern, but there has been a significant kind of a reduction coming in for Ethos, almost a 0.55 basis point. Apart from this, Raymond Iron Exchange also we saw cuts coming between 15 basis points. Lastly, I'd like to point out new entry coming in for Zentech. The stock is basically a kind of a view coming in for the semiconductor, and also Surya Roshni, Newgen Software. That's where he has paired his stake.
Okay, thanks very much, Sharad, for giving us all of those details. Sandeep, since we were talking a little bit about numbers, given that it's going to be a pretty hectic week this time around with their earnings, what is it that you're anticipating when it comes to some of the pharma names? You've got Dr. Reddy's that will be coming out with earnings, Cipla as well. What do you think the street wants to hear?
So pharma is a very interestingly poised sector today because it's a sector which has done well in the recent past. Many of the stocks have rallied substantially, but it's also a sector which is still under-owned. And to that extent, if we actually see improvement in profitability driven by lower input prices as well as improved pricing in the US markets, which many analysts have talked of, then I think it could give a fillip to the entire sector. So I think this will be one of the more interesting sectors to watch out for. So incremental margin improvements is something which I'll be watching out for, and that could drive these stocks further higher.
But Sandeep, this is one sector where if I look at the last 10 years, the hope and hype has been more than the actual delivery. It was supposed to be the next IT. It was supposed to be the play that, okay, American market will keep on cutting healthcare cost and Indian companies will keep on gaining. It was a play where specialized drugs would do well. In COVID, it was a $500 billion market which everybody was addressing. Barring one or two names, if I look at the 10-year track record or even 5-year track record, these stocks are volatile and even move crazier than commodity companies they move.
That's true, because they were overowned, expectations were too high, generic companies were getting valued like product companies, etc. And that's something market always misprices. So that's why I talk of time in the market and timing the market. So you have to spend time in the market, but time entry into sectors and stocks. So whoever held on for 10 years maybe made no money, but whoever bought 2 years back into some of the stocks like Reddy's or Sun Pharma, etc., they made decent money. So I think that's how I will put it. I would say that given the fact that they have consolidated for 10 years, increment and people have they become under-owned by most investors, incremental improvements could actually drive stock prices. So that's something we need to watch out for.
Let's get in a view on the charts then. And Kunal, come in on a United Spirits after we saw that result and the reaction, that fresh long build-up as well seen in the stock. What's your view on the charts? And quite the contrary when it comes to an SBI Life.
I think United Spirits was a classical breakout. So I remember, I think, suggesting the stock went to sub 900 when the stock was inching towards a short-term breakout more on the daily, weekly charts. But after yesterday's move, the stock coming closer to that 1,000 plus mark, in fact, breaking past about the 1,000 levels, the momentum seems to be coming back into the zone for United Spirits. So I think that's a classical kind of a breakout. And with this, the stock is now getting back into an outperforming zone with respect to most of the other peers. So United Spirits was a huge underperformer for the last 2-3 years. I think with the likes of Global Spirits and UBL, etc., doing exceptionally well, the stock underperformed. So I think it's trying to now play that catch up, which I believe is a strong signal of a trend sustaining for United Spirits. SBI Life, on the other hand, that stock got into a mild correction. It's confirmed a 5-day swing breakdown low, breaking below the 20-day moving average. That's going to be a key hurdle for SBI Life, because when stocks, after a steady uptrend of couple of months, when they break past below their 20-day moving averages, it signals some sort of a further consolidation or correction which could come back into the stock. So maybe another couple of days of correction is what I would anticipate for SBI Life, but a gradual cool off towards 1260, 1280 should be possible into the stock.
Sandeep, you've discussed banks, but let's do the top one. ICICI versus HDFC Bank versus Kotak, and Kotak versus IndusInd Bank. Which is the standout number?
So ICICI continues to stand out simply because of the fact that their commentary always is more realistic. They talk of net interest margin reduction possibilities, and they have talked of growth, risks, etc. And valuations are at 2.2, 2.3 times next year book value, so which is reasonable. And the stocks consolidated for a long time. HDFC Bank results were very good, but I would think that people are underestimating the impact of the merger and what impact it will have on both margins as well as the growth in the near term. Kotak Bank results were good, aided by some higher other income, but the valuations are very high, so I think that's a risk. IndusInd was fine, so but then there is always inherent risk in the balance sheet, and suddenly they come up with some results which surprise people. So I think that is still a lingering doubt in the minds of investors as far as IndusInd Bank goes. So overall, I would still be more bullish among these four on ICICI Bank.
The subsidiaries are firing full cylinder, and the fact that they are looking at delisting ICICI Securities, which in a sense was a forced listing because they needed tier 1 capital or needed capital, and they are looking at share swap, it just means that they pretty much know that which way the balance sheet of the bank is moving. I mean, that's one of the limited points which I just want to bring out. With IndusInd Bank, the problem with IndusInd and Kotak is that, look, they are not very large in insurance. They don't have a very large, NBFC business or microfinance business. So with IndusInd Bank, that's a limiting factor. Axis is building back. SBI has good subsidiaries. ICICI Bank has good subsidiaries. HDFC Bank now, it's new avatar, will have great subsidiaries. But IndusInd Bank and Kotak, in terms of subsidiary, Kotak still has a good securities business. But IndusInd Bank actually lacks that. Do you really want to go for a pure play bank? Nuresh, let's discuss Yes Bank. I mean, this is one stock where in general, the interest is very high. So let's keep the numbers aside, but purely on the charts. Yes Bank, Nuresh.
So technically, the stock has now found a new base. Earlier, the base was around, say, 13 rupees, which is where it used to pause out. And now the base has shifted to 15 to 16. If you look at the short-term charts, it's given a breakout above the 18 mark, which was roughly the resistance for the last 2 weeks, as well as has started making some bit of higher tops on a time frame of last 3 to 6 months. So the base is set. Technically, looks like we could be making a breakout move and go back to that 20 to 22 mark in the short term. And that is where it should again face a resistance. This was the top which was done in December 21. So 22 would be a short-term target. A longer-term trend only changes once it starts sustaining about 22. For now, it's a short-term trade wherein it could go towards the 20 to 22 mark.
Okay, meantime, let's also get in an outlook then on what the sense is when it comes to L&T, Sandeep. What do you believe that the engineering behemoth is going to deliver when it comes to its numbers? The stock has already scaled up quite significantly. The order wins keep pouring in. Execution seems strong. Do you think that we will see some sort of positive guidance when it comes to their margins and revenues?
Yeah, I would think that there should be an improvement in the overall order booking guidance as well as execution. Now, execution is something we need to see, but order booking, the kind of announcements itself which they have been making, indicates that order flow is very strong. I was also surprised by the announcement of potential buyback, and the stock is actually at a 52-week high. So the reasons for that, obviously, we'll see once the results come out, what the management says, why they are doing this buyback. But then it gives a very positive follow-through on how the management sees the business will actually perform. So overall, nothing to be negative from L&T's perspective. And despite its performance, etc., it again continues to be an under-owned stock among institutional investors.
All right, Sandeep, good to have you on board. Thanks so much for joining in and sharing with us your thoughts. A quick check-in as to what the pre-open rates are indicating this Monday morning, and around the 19,830 mark for the Nifty, with the Sensex up about 270 points as we speak. What about the mid-cap trades? What is it that our chartists are betting on, Kunal?
So I'll bet on IDFC First Bank, a stock which had started to consolidate over the last 2 weeks. I think on Friday it started to show signs that it's getting ready for a breakout. We saw good price volume candlestick for IDFC and IDFC First Bank. both of these stocks. So I would suggest a buy in the anticipation of a breakout. 88 as a immediate target for the stock, and stop loss could be kept at 80.
Okay, watch out for IDFC First Bank, target 88. Nuresh, your top mid-cap call?
So that would be a buy on Bandhan Bank, a risk-reward trade here. The stock has corrected sharply all the way from 270 plus levels to 215. Yesterday saw a block deal happen and a reversal candle finally. So keeping a strict stop loss at 213, expecting this to bounce back and recover at least some part of the down move towards 240 levels. So a risk-reward trade here on Bandhan Bank.
Okay, that's Naresh's top mid-cap call. But here are some of the other top stories and headlines. Well, Twitter, yet again in the spotlight. This time, Elon Musk says he wants to rebrand the platform, reflecting his vision to create what he calls a super app. The well-known Twitter logo, it could be replaced by an X logo, and soon we're going to be bidding adieu to all the birds that have been, of course, the key feature of Twitter, according to Musk. Meantime, Coffee Day Global, which operates the Cafe Coffee Day chain in India, has been admitted for corporate insolvency by the Bengaluru bench, according to the Economic Times. Meanwhile, the NCLT has passed an oral order last week to admit the unlisted company based on a petition that has been filed by IndusInd Bank. And in one of the biggest box office face-off in years, Barbie versus Oppenheimer, the cash registers have been ringing over the weekend. While Christopher Nolan's Oppenheimer has clocked in $80 million in the United States and $93 million from international territories, Barbie has generated a record-breaking $155 million and a global debut of just over $337 million. That's really something. Meantime, in the world of politics, the British PM Rishi Sunak and his family chose to watch Margot Robbie's film Barbie versus Oppenheimer. He took to Twitter actually, and he shared a picture with his family in the theatre, which features him with his wife, that's Akshata Murthy, and their daughters Krishna and Anushka in pink, of course. Moving on, a 30-member team from ASI has begun a scientific survey of the Gyanvapi Mosque in Varanasi, which is aimed at determining if the mosque was built on top of an ancient Hindu temple. The survey coincides with the Supreme Court hearing that on a petition that has been filed by the Mosque Management Committee, which challenges the Allahabad High Court's decision upholding the right of Hindu women to worship inside the Gyanvapi Mosque. Meantime, IMD has issued a red and orange alert across states due to the adverse weather conditions. Many districts in Gujarat are flooded, and you've got fresh bouts of rain which are expected to hit Himachal Pradesh. Similar fate is expected in UP and Rajasthan as well. In isolation, Mumbai is expected to receive heavy rainfall over the next 72 hours, with an orange alert being issued.